All right, guys, we're going to go over identifying bearish and bullish gap zones. These are what you would normally call an FVG, which is a fair value gap. And this is what most people call them, but they're coded differently and going off of different parameters than what I look for. So that's why I'm showing you the way that I look at it so that you'll know how to do this on your own until we get our indicator ready that'll do this for you on the screen. Okay. So the first one that we're going to look at is a bearish gap zone. So we've looked at the candle patterns and all the different structure points. So what do we have here? We have a structure point, right? But inside of that structure point, here's another structure point. But what are we looking for? We're looking for this area right here, this gap, the gap between this wick and this wick after 3 candles of the exact same trend, meaning same direction, have formed. So it could be 3 candles or up or 3 candles down. So let me clear my drawings real quick. Let me go to my vanishing pen. Okay. So now we have a wick here and a wick here and the distance between the two. That is the zone that was formed right there. And here, and what you're looking for is there to be a gap between this wick and this wick. If you find that your candle wick goes down and this candle wick on that third one comes up and they meet in the middle there, well, then you don't have a gap. There's no gap that was formed. You can clearly see that the wick of this candle and the wick of this candle never touched in the center. So that left the gap there. Same thing here. There's a wick there and there's a wick there and there's 3 candles of the same direction. So 3 bullish candles. So now we have that gap that formed here. This would be the zone. And you would be looking for price to pull back into it and pull out of it. Same thing with this one. Price to pull into it and out of it, right? So we're going to look at the same thing now, just like I showed you. You have the same gap that I just showed. And if that would have played out, if this would have been a proper trade, a valid trade, a credible trade, a trade that we have already validated and said this is it, then and we know this is a peak. So if this was a peak and we know that a structure point has been formed in that direction, which would have, I've circled that obnoxiously too much. So we're going to keep it small here. All right. So we've identified the peak. We've identified that this is previous data. This is present data. We've identified that the market has left a gap here in this area, right? And now we've identified that price has pulled back into that gap and it left a bear followed by a bull. And it does not matter if that bull candle was this big or this big or as big as it is. All we need is a bear bull inside of this gap that was formed between this wick and this wick. So as soon as we saw that price came back in and it closed, I would look on a lower time frame, the lowest time frame that I could after I had established that there was a bear candle that closed in it. I want to find an Inerva signal on a lower time frame at this point right here. And I want to buy that when this candle closes. When this bullish candle is closed, I want to get in. Now, I would get in right here as soon as the next candle opens, even though there could be drawdown. I don't care because I know that the overall direction is going up. And I know that it's not going to surpass either this point or this point if it's a valid trade. Okay. So let's go into actual uh, wrong one. Okay, we'll go to this one. So in this example, there's only one valid gap zone that would have kept itself on the chart, right? That's this one. And what I like about this one is that price was going up. It just kept going up, right? All the way to that point. And then it came, and what did it do? This peak one, right? So what does that make everything back here? That makes it previous data, which makes these previous structure points, right? All of these are previous structure points. So price would need to touch, retouch, break these, right? Isn't that what we've already discussed? And if you look right here, this was a news event. This candle, I can't even go to the whole thing because it's all the way down here. You can see how far that dropped. But my point is, it went and it took out every single one of those structure points. And what did it do? I got to clear the drawings because look at this. Here's a wick. Here's a wick. Now this one right here on a higher time frame, this candle was not blue. So this is why you're seeing this and being like, that's a blue candle and that's a white candle. I thought it was supposed to be 3 consecutive. On a higher time frame, when I drew this, this was a white candle. So it did leave that gap appropriately. And when it left that gap that was there, it took out all of this. That was not necessary anymore. Now we're in present moment, right? Everything happening is in the present moment gap. And the gap zone that forms within the change of character is the most valid one that you're looking for price to pull back into and go the same direction of the break. The break is this direction on this example because it broke all of these structures that were needing to be broken. All of them were broken with one candle that also left a fair value gap at the same time. And that fair value gap gives us a location for price to pull back into before it continues down. Sometimes it's just going to pull into it and go down. Sometimes it's going to go all the way back up and retest, because here's 2 trades that you could take, right? Because just because this came down and back up into this fair value gap at this location does not mean that it's going to surpass this point, right? Because there's a supply right here. Let me clear that and make it another color. There's a supply here, right? So we know that untouched supplies, because once this was formed, it did not get retested. There was no candle that came back up and retested it after it went down and created that supply. This is a supply that was created after the fact of this candle that went down, right? So we don't have a retest of this, and price always retests these zones. So you could see this come in and go 1, 2, 3, straight back up to retest that, and then 4 finally drop down, right? So this is what a fair value gap is on what you'll be looking for. Again, you have to draw these yourself. You have to identify these yourself because we don't have the indicator for that. You can look at other indicators out there. I personally have, and I don't like what I've seen. It hasn't aligned with what I'm looking for perfectly, and I want that. I want that synergy to be perfect so that it's actually capturing what I'm showing you. So until that point, we're going to all draw these together. They're very simple to draw. They're very simple to see. You can see there's another one right here. This is a gap. Wick. Actually, I drew that bottom one wrong. But wick to wick. This one doesn't even have a wick, but there's still a gap there. So that means that price could pull back into this one now and drop again, or it could completely fill that gap. Just because there's a fair value gap there does not mean that price has to bounce off of it. It could mean that price is just going to pull back into it and it's going to go and fill the gap and continue going up to retest what we talked about before up here. And then it's probably going to leave another gap in this area that is going to have a pull back into it and then go down because now we're going in the right direction. But the thing is that you're looking for more predominantly, you're looking for a sell-off, not from an FEG, even though those are possible. And you can do that. If you have these big candles like this and you see that happening and that forming, then absolutely yes, take it to the low, the previous low that was created. But the more predominant trade that you want, the one that has the less drawdown, the one that has the more security, is the one that's going to the supply. That's going to come back, retest it, and tank. And it's going to break every single one of those structures. That's the trade you want. That's the one that's worth waiting for. So you're going to spend more time waiting for your trades. But I wanted you to know what these gaps are so that you can see that you can find trades, valid trades that are going to happen in these areas. And as you can see, this one was a valid trade that it happened. I don't remember how this one played out. This was a while back when I put this together, but now I want to go look. Now I want to go see what happened here. But anyway, that's a fair value gap, and it doesn't matter what direction you're going with it. And the moment that price, hold on, let me do this real quick. So like this one right here, once price closes above a sell gap zone, it needs to delete itself. So you need to delete this zone the moment that price closes above it. So this gap was formed from this wick here and this wick here. And then price came back up and it closed above it. This candle here closed above this line on that gap. So now this entire thing is irrelevant and you need to remove it from your chart. Once the gap gets filled and breaks above it, it's no longer relevant to be there. So if this right here comes back up, comes all the way up to this point and then goes down, and it never broke this point, it's still valid. It still stays on the chart. Okay? All right, guys. See you in the next video.